They were supposed to deliver growth and dominance, but all they've given their companies is headaches and broken promises. These are the biggest investment burdens, the worst business deals in corporate America today. AT&T is $130 billion in the red, one of the worst debts in corporate America, because they have not one but two horrible investments on the books. Of course, we're talking about Time Warner and DirecTV, whose failures not only destabilized AT&T between 2018 and 2021, but they will probably destabilize the next few years as well. Time Warner lasted just 4 years under AT&T's control, and when it was in operation, it was without direction, without synergy, and looked bloated and misaligned. It was a complete failure from the first day. The once dominant media giant was still effective in content output and subscription revenue, but the competitive edge and brand dominance it once had simply evaporated. And financially, it was even worse. Time Warner's market power, which had always fascinated given its size and reach, had completely disappeared. Time Warner became so ineffective that competitors systematically beat them in streaming, and AT&T kept losing millions of dollars each and every day. AT&T didn't suddenly forget how to invest, but it was painfully clear that Time Warner needed to be shut down and they refocused on what they knew how to do best. It's now 7 years since AT&T bought Time Warner for $85 billion, which will keep them hooked financially way beyond 2026, costing them billions of dollars in wasted opportunity. And due to the massive debt load and the complicated aftermath, which include high-level asset sales, dividend cuts, debt restructuring, and a refocus on core operations, which involves offloading Time Warner to correct years of financial instability, AT&T's future doesn't look that good. And the same can be said about its other deal, DirecTV, which spent the majority of its time under AT&T battling losses and setbacks, which was also a problem for AT&T. Like Time Warner, DirecTV looked like a shell of the company it once was, losing millions of subscribers year after year. Its nationwide reach, which was once its main calling card, has been shredded to pieces. DirecTV is 30 years old, got paid $48 billion in 2015, and AT&T will keep feeling that financial pain for years to come. DirecTV is one of the main reasons why AT&T experienced significant subscriber losses. AT&T is $130 billion in debt, with two failed acquisitions behind it, without any success between them. Time Warner and DirecTV are like two 500-pound stones tied to AT&T's books, weighing the company down to the bottom of the corporate ladder. And it will be a miracle if they ever regain their old form. But not every downfall comes from poor acquisition deals. After Paramount enjoyed a surge of relevance during the streaming boom and owned some of the most valuable shows in entertainment, Paramount went deal hunting. First, they acquired Pluto TV, giving up internal resources, strategic focus, long-term vision, and millions of dollars. But that kind of yield was expected for a platform such as Pluto TV. And when you can get Pluto TV, you go for it, no matter the cost. The problem was the second big move Paramount made when they acquired Showtime under their direct control. A move that diverted billions in capital, leadership focus, and a long-term financial flexibility, all to prop up a declining brand. But Paramount wasn't done there. They also shut down Paramount Television, which was a division once known for producing acclaimed series like Jack Ryan, Defending Jacob, and the action thriller Reacher. In a span of few years, Paramount acquired two glossy streaming brands, but they lost their engine. In the last few financial years, Paramount could never find proper strategic balance with their two streaming platforms, dropping all the way down to the 5th most watched streaming platform in the US. Financially, they regressed, from showing the most stable returns in the sector to a sharp decline. And when they faced fierce competition from other streaming platforms, it was an abomination. The company could do nothing to stop massive and crippling subscriber losses, getting hammered on Wall Street, losing billions of dollars in lost revenue in the last few years. However, Paramount isn't the only company that gave up millions of dollars for a fading brand. Just look at Meta, who made one of the dumbest bets in recent memory when they've paid billions of dollars in building Metaverse. Granted, the Metaverse was once seen as the next breakthrough innovation in tech evolution, and in 2021, Facebook changed its name to Meta. But the strategy has delivered limited results, generating more losses than returns throughout the entire time, bringing more doubts than belief. For such a one-dimensional bet, Instead, Facebook spent over $50 billion into the Metaverse and lost focus, which is more than Paramount spent for Pluto TV. The modern tech landscape is a cutthroat industry based on revenue growth, and to pay such a hefty price on a project that is not proven, it's beyond comprehension. But to make things even worse, Facebook overlooked businesses that were arguably better positioned strategically than the Metaverse. For example, WhatsApp was part of Facebook's core lineup, but unlike Metaverse, it operated at the edge of real consumer demand, powering global communications with unmatched reach, real-world utility, and efficiency. In today's tech economy, where conversion and daily engagement drive value and long-term platform dominance, building platforms around real user behavior is arguably more valuable than speculative innovation. WhatsApp is also more valuable as a revenue-generating platform and monetizes effectively. But if Facebook really wanted a proven growth engine, they already had one in Instagram. Now, to be fair, Instagram was still evolving, especially in short-form video and creator monetization at that time, and nobody could have predicted how good it was gonna be. But Instagram, a product that Facebook had owned since April of 2012, proved to be a phenomenal growth engine, driving user engagement at a scale that far outperformed the Metaverse, which has delivered weaker results in the last few years. Across the tech industry, Instagram ranks among the top platforms for user engagement. It's consistently growing in ad revenue. The Metaverse also is burning cash like it grows on trees. And if there's a lesson here, it's this: that big money doesn't always mean big results. Only a handful of initiatives have cost Facebook more than the Metaverse has during this 3-year run. And while this next investment isn't really a bad idea because it backed one of the most promising startups in the world, when you factor in how little it delivered, it becomes one of the most overpriced business deals in corporate America. And it's a shame that SoftBank needs to be mentioned. But since it first backed WeWork, the startup burned through billions and delivered almost no returns. Even worse, after the $47 billion valuation in 2019, WeWork never reported a profitable quarter, running into every major setback you could have ever imagined. SoftBank kept pouring in capital through multiple bailouts, and year after year they kept losing billions of dollars from 2017 through 2023, which wouldn't have been a problem if WeWork was profitable. If we divide the amount that was spent by the amount that SoftBank invested in that period of time, the company lost a staggering $11 billion in a very short period of time, which is a hefty amount, and why it gotta be mentioned among the worst business deals in corporate America. But SoftBank isn't the only major multinational giant with a failed acquisition that was a little too pricey. Even before the crash, Peloton's high valuation was too inflated for the phase the company was in, despite its impressive growth metric. Yes, still, Peloton was generating a lot of revenue, growing from $915 million to $4 billion in 2 years. Its connected fitness model worked seamlessly, growing from 500,000 subscribers to 2.3 million by 2021. And while Peloton was once celebrated as a market disruptor because of its amazing growth from 2019 to 2021, the company had poor leadership from the start. They did not take careful measure to ensure sustainable growth and only focus on hypergrowth at any cost. So therefore, even with strong subscriber numbers, Peloton's performance eventually crashed. And then, after the pandemic, everything fell down the drain. Demand started to normalize, which resulted in a drop of equipment sales, causing the company to stop production. And to make things worse, they had to lay off thousands of workers. With Peloton's growth story all but over in 2025, the company's best path forward is to re-strategize again and go into a rebuild. Now, it's easy to recognize bad business deals for big corporations who are still dominating in their respective industries. But how about small ventures who failed to meet expectations? One such example came out of Silicon Valley, and its name is Quibi.
The short-form streaming service Quibi, the startup is shutting down after just 6 months.
On paper, Quibi was every investor's and founder's dream, a platform backed by Hollywood with $2 billion in funding, which promised to dominate mobile streaming with high-end short-form content. But in reality, Quibi was one of those startups that never evolved past its colorful launch. Strategically, it had all the tools to carve out a niche in streaming, but the product felt disconnected, poorly timed, and clunky, and failed to capture any real viewer attention. And it's the same story operationally, when Quibi sat on the sidelines watching the real streaming giants take over, without even making a real move to stand out. Quibi was also underperforming in areas where it was supposed to shine and operated in a vacuum, offering zero creativity in market research. Quibi raised $1.75 billion in first and second round funding before it even had a chance to prove itself. But unfortunately for investors, it looked like one of those startups that wasn't really built to last, and its only real motivation was securing the bag. Thank you for watching, and if you like this video, we have another one for you right here.